Hello friends, welcome once again. Today we are starting practice set for NISM V-A, that is examination conducted by National Institute of Securities Market NISM for becoming mutual fund distributor. So we have already covered how you can apply for that, what is the eligibility criteria and what are the earning potential after completion of this course. So today we are starting the practice set of the questions we have already appeared in the previous examination or those which are expected to appear. So we'll get right to it. Question number 1. A close-ended mutual fund has a fixed. Options are A. NAV, B. Fund size, C. Rate of return, and D. Number of distributors. So we'll find the answer here. A closed-ended mutual fund has a fixed fund size. So we will explain how this answer is arrived. First of all, look at the NAV. NAV is the value of per unit assigned to that mutual fund portfolio. For instance, if an NFO comes, usually unit NAV is 10 rupees. So whenever the market goes up or down based on the underlying portfolio, the value of this NAV goes up or down. That's how you make money as an investor, right? So NAV cannot be fixed. In case of closed-ended fund, they only collect the fund during NFO period. So initial invested fund will always remain the same. Now rate of return is market dependent. As we all know, in securities market, you cannot decide rate of return or cannot keep a fixed return. Number of distributors can be n number of distributors. After passing this exam, you also will be becoming mutual fund distributor and join as a distributor any point of time. So we'll go to next question. Question number 2. The maximum load that a fund can charge is determined by option A, AMC, that is Asset Management Company. Option B, SEBI, that is Securities and Exchange Board of India. C, AMFI, that is Association of Mutual Funds in India. Option D, distribution agent based on demand for the fund. The maximum load that a fund can charge is determined by A, AMC, B, SEBI, C, AMFI, D, distribution agent based on demand for the fund. Now we'll look for the answer. So the answer is B, SEBI. SEBI is the governing body for security market as a whole. However, the AMC can decide the load applicable on the scheme provided that this maximum load should not cross the limit set by SEBI. So we'll move on to next question. So question number 3. The amount required to buy 100 units of a scheme having an entry load of 1.5% and NAV of 20 is option A, rupees 2000, option B, rupees 2015, option C, rupees 1985, option D, rupees 2030. Entry load is the amount of charge that an investor has to pay initially. Yes, this is upfront cost. 100 units of NAV 20, that means total invested amount is 2000 rupees. So yeah, entry load should be 1.5% of this investment amount, that is 2000 rupees. So 1.5% of 2000 is 30 rupees. The total amount required to buy is 2000 rupees plus 30, that is 2030. Option D. Let's look at the answer. Yes, it's 2030. If you don't understand this or if you have any confusion in this question, you can write in the comment box. We will provide a solution separately. Question number 4. A gilt fund is a special type of fund that invests, option A, in very high quality equity only, B, in instrument issued by company with a sound track record, C, in short term securities, and option D, in government securities only. I'll repeat the question. A gilt fund is a special type of fund that invests A, in very high quality equity only, B, in instrument issued by company with a sound track record, option C, in short term securities, option D, in government securities only. We'll discuss this option, but first we'll go for answer. So the answer is D, in government securities only. So we will discuss this question in little detail here. The type of fund which invest only in government securities. It can be treasury bill, it can be RBI bond. We'll discuss other types of. Option A is in very high quality equity only. This option roughly signifies to blue chip equity fund. Option B, instrument issued by company with a sound track record. This option B, signifies NCD or corporate deposits. Option C, in short term deposit. So for short term there is a separate funds we call a short term bond fund, or it can be liquid fund also. Question number 5. Of the following fund types, the highest risk is associated with A, balanced fund, B, gilt fund, C, equity growth funds, D, debt funds. So the answer will be C, equity growth funds. Okay, so equity growth fund is riskiest among the given options. After that, balanced fund, or it is also called balanced advantage fund. In this, a portion of investment is parked into debt asset and remaining chunk is parked into equity funds, since its volatility will be lesser than that of equity growth fund. Next comes debt fund. Debt fund means there is no equity allocation in this fund. It can be a government deposits, company deposits, NCDs, or fixed income products. And in previous question we have already discussed gilt fund. So we'll move on to next question. The NAV of mutual fund is A, always constant, B, keeps going up at a steady rate, C, fluctuate with market price movement, D, cannot go down at all. I'll repeat the question. The net asset value or NAV of a mutual fund: A, always constant, B, keep going up at a steady rate, C, fluctuates with market price movement, D, cannot go down at all. I think this is the easy one. You can easily answer. We'll move to the answer. Answer is C, fluctuate with market price movement. Let's move on to next question. Question number 7. An open-ended mutual fund is one that has, option A, an option to invest in any kind of securities, B, units available for sale and repurchase at all times, C, an upper limit on its NAV, and D, a fixed fund size. So we move to answer. Answer will be B, units available for sale and repurchase at all times. So this is the fundamental difference between open-ended and closed-ended. In open-ended, you can buy and sell securities or the mutual fund units at any time. Okay, so moving on to next question. An investor in a closed-ended mutual fund can get his/her money back by selling his/her units. Option A, back to the fund, B, to a special trust at NAV, C, on a stock exchange where the fund is listed, D. To the agent through which she has subscribed to the units of the fund. This question is very important because we already know that in close-ended you cannot buy or sell easily, just like in open-ended fund. So in case if you have to sell it, so how can you sell, right? I mean, how can you get your money back or your investment back before the maturity or the closing of the fund? So the answer would be C, on a stock exchange where the fund is listed. The load charged to an investor in a mutual fund is option A, entry fee, B, cost of the paper on which the unit certificates are printed, C, the fee the agent charges to the investor, D, the expenses incurred by fund managers for marketing a mutual fund scheme. These are the four options and we'll move on to the answer. This answer is D, the expenses incurred by fund managers for marketing a mutual fund scheme. So it can be marketing material, distribution, commission, or salaries to the staff and employees, research material purchase. These expenses are called load. In common parlance, they call it load. As per SEBI, it is called TER, total expense ratio. So move on to next question. A mutual fund is owned by option A, the Government of India, B, SEBI, C, all its investor, D, AMFI. So the answer is mutual fund is owned by all its investors. Move on to next question. Question number 11. Units from an open-ended funds are bought A, on a stock exchange, B, from the fund itself, C, from AMFI, D, from stock broker. Find the word open-ended. In one of the questions, closed-ended funds are traded only on stock exchange. But in case of open-ended, they are not listed on stock market. The answer will be B, from the fund itself. That is, the mutual fund company itself will buy and sell this units. Question number 12. A mutual fund is not A, owned jointly by all investors, B, a company that manages investment portfolio of high net worth individuals, C, a pool of funds used to purchase securities on behalf of investor, D, a collective investment vehicle. See, these type of questions are very easy, but only thing that you have to read the question carefully. Here it is asking a mutual fund is not. That means out of the four options, 3 should be true for a mutual fund company, and the one which is not true, that you have to select. Answer is B. A mutual fund is not a company that manages investment portfolio of high net worth individual. See, in mutual fund, anybody can invest 100 rupees to 2000 rupees of starting value. That means anybody can invest in that. So high net worth individuals are not the only one who can invest. Say, mutual fund is not an exclusive product for high net worth individual. For high net worth individuals, we have a separate product category. It is called PMS, that is Portfolio Management Service, or AIF. So what basically mutual fund is? So you can understand like this. A mutual fund is a collective investment vehicle owned jointly by all the investors, a pool of fund used to purchase securities on behalf of these investors. So move to next question. So question number 13, load cannot be recovered A, at the time of investors entering into the fund, B, as a fixed amount each year, C, at the time of investors exit at the fund, D, from the fund's distribution agent. So we'll see the answer here. Answer is D, from the fund's distribution agent. That means once you pass this exam and become a mutual fund distributor, the load will not be recovered from you. Right, because it doesn't make sense if the distributor has to pay the commission and charges. It should be other way around, that you should be getting paid, right? So we'll move to next question. Question number 14. The most important advantage of a money market mutual fund is option A, quick capital appreciation, B, high regular income, C, safety of principal, D, no loads. This should be an easy question. Money market, or you can know that call money, that is very short term security papers. When do you invest a short term papers? When you need liquidity and you have to park the money for small period of time. So money market mutual fund basically investment call money or very short term funds, right? So answer will be C, safety of principal. Since the exposure of the fund is for very less period of time, the safety of principal can be ensured. So in case of money market, the banks borrow for either overnight or at max 14-15 days, so that they can maintain this regulatory requirement of money. For that they pay some good interest. What is there for investors here? So as an investor, if you keep the cash, you will not get anything. But if you give the bank for their daily requirement at the time of EOD, they will be paying you a little bit of interest. Moving on to next question. Question 15. Some close-ended funds are quoted at a discount to their NAV because A, of high expense ratio, B, investors do not expect the current NAV to be sustained in future, C, the repurchase price fixed by fund is lower than the NAV, D, the inherent risk involved in investing in such type of fund. See, we are talking about close-ended fund here, and they are asking why some close-ended funds are quoted at a discount to their NAV. We have already discussed this question in one of the previous solution. Because there is no liquidity, right? The mutual fund company cannot buy or sell the units, so it has to be traded on exchange, right? So this create either supply or demand, and because of this it is quoted either on discount or premium. So we will understand why discount and why premium. When the demand for the listed unit is high, that means people are willing to pay more to acquire the units, then it will be trading at a premium above NAV. And when people are not willing to buy or more people willing to sell, then it will be available at a discount, just like normal stocks, right? The answer should be B. We'll look at this. Okay, so answer is B. Investors do not expect the current NAV to be sustained in future, right? That's why they're selling, no, because they know, because they believe that this current NAV is not going to sustain. It is going to come down, so they will sell it before it actually go down. And because of that, since more people are coming to sell it, the price will come down. Next question. Question number 16. The NAV of each scheme should be updated on MFI's website. Option A, every quarter. Option B, every month. Option C, every hour. Option D, every day. So net asset value, this should be easy for you, right? Net asset value of each scheme is updated on MFI website at what frequency? Yes, exactly. Option D, every day. Question number 17. Debt fund target A, low risk and stable income. B, protection of principal. C, high growth with risk. D, long-term capital appreciation. Again, this should be easy. So the target market for debt fund is people who are not willing to take risk, right? Because if they wanted to take risk, they will go to equity only, no? So the answer is B, protection of capital. In other class, some people were saying that it's option A, low risk and stable income. See, there is a little difference here. In debt fund, there is a category called fixed income, right? That means what you get at the certain period of time or at a certain frequency, that will be called fixed income. If it is written as fixed income funds, then option A will be correct. But here it's asking debt fund. So answer is protection of capital. Question 18. In which of the following do debt funds not invest? A. Government debt instrument. B. Corporate paper. C. Financial institutions bond. D. Equity of private companies. In which of the following do debt funds not invest? A. Government debt instrument. B. Corporate paper. C. Financial institution bond. D. Equity of private companies. So the answer would be D. Equity of private companies. In fact, no fund can invest in equity of private companies because private companies are not listed on stock exchange. They cannot buy except one option, that is pre-IPO placement. When the company or private company is willing to go public and bring its IPO, for that the mutual fund company can invest as an anchor investor. Question number 19. Which of the following risks do not affect a debt fund? A. Default by issuer on payment of interest or principal. B. Price fluctuation of the debt securities. C. Share price movement. D. Interest volatility. We'll repeat the question. Which of the following risks do not affect a debt fund? A. Default by issuer on payment of interest or principal. B. Price fluctuation of the debt securities. C. Share price movement. D. Interest volatility. The answer will be C. Share price movement. See, the reason being a debt fund do not invest in equity market, right? So share price movement has no correlation to the debt fund. The other three options can affect the NAV of the debt fund, right? If one of the investments does not perform, that means the issuer failed to pay the interest on time, so they have to take the loss, the debt fund, and the NAV will come down. In case of B, debt securities are also listed on exchanges, and anything that is listed on exchange has a potential to trade at a discount or premium. So because of that, fluctuation in NAV will happen. And interest volatility, change in interest, this is a very important factor here, because change in interest changes the NAV or the demand of that fund, right? So answer will be share price movement. Question number 20. Assured return or guaranteed monthly income plans are essentially A. Hybrid fund. B. Growth fund. C. Debt income fund. D. Sector funds. So assured return or guaranteed monthly income, that means it's a fixed income. And from the option itself, I think you might have already guessed it. So the answer will be C. Debt income funds, or it is also called fixed income funds. So I'm moving on to next question. Question 21. A fixed term plan series is option A, an open-ended fund. Option B, a closed-ended fund. Option C, a fixed term bank deposit. Option D, fixed term corporate deposit. So the answer will be B, closed-ended fund. Fixed term plan, that means they will tell you at the time of NFO itself that when it is going to mature. Question number 22. NAV of equity funds are not affected by A. Stock market movement, B. Event affecting the industry sector in which the fund has invested, option C. Happening in the companies in which the fund has invested, option D. Real estate prices. So the answer is D. Real estate prices. See, it is equity fund. It has nothing to do with real estate prices. That means the price of the property itself. This doesn't mean they cannot invest in real estate companies' equity. Right? So move on to next question. Question 23. The greatest potential for growth in capital is offered by A. Debt fund, B. Gilt fund, C. Growth fund, D. Balanced fund. So the answer is C. Growth fund. See, we have already discussed the risk and reward parameters. That means all equity is highest risk, and greater the risk, greater the return potential. Question number 24. A systematic withdrawal plan SWP allows investors to get back the principal amount invested in addition to the income on investment. True or false? So this is a true statement. Question 25. Which of the following is untrue of an automatic reinvestment plan? Option A. The plan allows for automatic reinvestment of all income and capital gain. B. Automatic reinvestment allows for accumulation of additional unit of the fund. Option C. Major benefit of automatic reinvestment is compounding. D. The benefit of automatic reinvestment is often lost on account of the heavy load charges on reinvestment. So it is asking which of the following is untrue. So automatic reinvestment plan, that is any return or any income that you generate on your existing units, should be reinvested. That is the kind of mandate you give to the AMC. So which of the following is untrue in that? So answer will be D. The benefit of automatic reinvestment is often lost on account of heavy load charges on the reinvestment. This is a wrong statement. That's why this is our answer. Here, the reinvestment is a preferred mode of investment. That means any return you make should be automatically reinvested so that you do not lose on timing the market or opportunity cost. That means you are simply, as an investor, you are simply giving the AMC an opportunity to reinvest. Question 26. Constraint imposed by most funds on check writing are A. Account balance should not fall below minimum capital required. B. Check issued must be for at least the minimum amount specified. C. Number of checks per month must not exceed a specified number. Option D. Both A and B. So if you read the question once again, I think you can understand it. Constraint imposed by the most funds on check writing are. So the answer will be D. Both A and B. Question 27. The performance of a fund is largely measured by the success of A. Marketing function, B. Operation function, C. Portfolio market function, D. None of the above. So the answer is C. The portfolio market function. So question number 28. Generally invest in, I think there is something missing here. So the question should be, I'm guessing here, generally the mutual funds invest in A. Unlisted, B. Market traded, C. Thinly traded, D. Privately traded. So answer will be B. Market traded, because if the stocks in which the mutual fund wants to invest or the security paper in which the mutual fund wants to invest is not readily available or not liquid in the market, they have to sometime pay a high premium, right? So the risk of unnecessary volatility will be there in case of thinly traded or not traded. That's why public market traded securities are the preferred investment mode. Question number 29. Which of the following is not an equity instrument? A. preference share, B, equity warrants, C, ordinary debentures, D, convertible debentures. So if you know the definition of these four items or instruments, you can easily understand. If you want discussion on these instruments individually, please write in the comment. Meanwhile, the answer will be C, ordinary debentures. Question number 30. The drawback of an ordinary share is A, possibility of capital appreciation, B, ownership privilege of the company, C, guaranteed dividend income, D, no guaranteed income or security. I think you must have already understand. The answer is D, no guaranteed income or security. Question number 31. An owner of preference share is given which of the following rights? A, voting rights, B, fixed dividend income from post-tax profit, C, voting rights and unlimited dividend income, D, no guaranteed rights. So preference share are basically the company issues a certain amount of shares at a preferred rate or preferred privileges, right? So it can be for any reason, like the investor is having good expertise in something which is beneficial to the company, or the company is in trouble and needs fund, so they will give a certain favor to the investor who are willing to take a risk at the time when the company is struggling. So for that, usually they provide a certain set of privileges to the investors, to the preferential investors. The company issues share to them. It can be either at par, that means at market price, or at certain discount. And second, they offer certain dividend. It can be a fixed dividend, or they can get a little bit more than what ordinary investors get in dividend. So these are some of the privileges. So the answer should be B, fixed dividend income from post-tax profit. Question 32. Market capitalization of company is calculated by multiplying the number of outstanding share by A, rupees 10, B, face value of each share, C, current market value of each share, D, dividend yield. The answer you must be knowing it. 32 ka answer C, current market value of each share. Question 33. The price to earning PE ratio is an important measure of a company's anticipated performance. It is calculated using A, market price and dividend, B, market price and earning per share, C, market capitalization and dividend, D, market price and face value. If you read the options carefully, the answer is here itself. So the answer is B, market price and earning per share. This is basically the price of the share listed on market divided by the amount of profit or earning the company generate per share, that is EPS, earning per share. Price to earning. Question number 34. A company whose earnings are strongly related to the state of economy is known as A, economy stock, B, cyclical stock, C, value stock, D, growth stock. So answer will be B, cyclical. Here, answer is B, cyclical. Question 35. A growth stock refers to shares of a company whose earnings are projected to grow at a normal market rate. Statement is true or false. So obviously this is false statement. Question number 36. Which of the following is generally true for a growth stock? A, steady capital appreciation and steady dividend yield. B, high capital appreciation and high dividend yield. C, high capital appreciation but low dividend yield. D, steady capital appreciation but high dividend yield. So the answer will be C, high capital appreciation but low dividend yield. See, you can understand growth stock like this. Uh, if it is growing faster, that means it can reinvest its capital into the company itself. So how can they pay dividend, high dividend, right? So a growth stock cannot be a high growth and high dividend yield at the same time. Question 37. Shares of companies with large capital market capitalization: A. Have greater growth potential. B. Are more liquid. C. Are not available. D. None of the above. Answer is B. Are more liquid. Since more number of shares are traded, it's easier to buy or sell because more number of people are available. Question 38. Dividend yield for a stock is: A. Dividend per share. B. Dividend per face value. C. Dividend per share to current market price. D. None of the above. So answer is C. Dividend per share to current market price. 39. Value stock. Option A. Have high current dividend yield. B. Yield high growth in earning. C. Are currently undervalued. And D. None of the above. The answer is A. High current dividend yield. Question number 40. A better performance than the return on index is given by: A. Passive fund manager. B. Active fund manager. C. Alt fund manager. D. Non-fund manager. So answer is B. Active fund manager. Right? Question 41. A change in key personnel, especially the fund manager of an AMC, does not necessitate a revision of the offer document. Option A, true. Option B, false. So this is a false statement, because every time a key personnel of a fund changes, they have to inform the investors as well as SEBI, and they also have to update the offer document. Question 42. If fresh litigation cases or adjudication proceedings are referred by SEBI against the fund sponsor or a company associated with the sponsors, then the offer document need to be revised. True or false? So the answer is true. 43. The offer document need not be revised if the management or the controlling interest in AMC change. The offer document need not be revised if the management or the controlling interest in AMC change. A, true or false? Obviously, this is false statement. Question 44. An AMC cannot explain adverse variation between expense estimate for the scheme on offer and actual expense for past scheme in A. Financial newspaper. B. Business news channel on TV. C. Offer document. D. MF newsletter. So the answer is C. Offer document. Question 45. Information on estimated expenses to be incurred by a scheme is not found in offer document but in brochure of the fund. True or false? The answer is false. Question 46. When comparing a fund's performance with that of its peer group, the following cannot be compared: two debt fund with 5-year maturities, a broad-based equity fund with IT sector fund, a bond fund with a bond, D. A government securities fund with a government security. Right? It is asking which cannot be compared. Right? So answer is B. A broad-based equity fund with an IT sector fund, because broad-based equity is a market fund, or you can call it index fund, and IT sector is a sectoral fund. So these are two different categories, and two different categories cannot be compared. Question 47. An AMC must explain adverse variation between expense estimate for the scheme on offer document and actual. I think we have already done this question. So option A, expenses for past scheme in financial newspaper business channel on TV, offer document, AMFI newsletter. We have already done this. The answer is business channel on TV. Question 48. Information on estimated expenses to be incurred by a scheme is not found in offer document but in brochure of the fund. True or false? Obviously, it's a false statement because estimated expense they have to give in offer document. Question 49. The offer document and key information memorandum, that is KIM, contain financial information for A. All scheme of all mutual fund in the capital market. B. All scheme launched by particular fund during last 3 fiscal year. C. None of the scheme. D. Companies in which investment is proposed. So the answer is B. All scheme launched by the particular fund during last 3 fiscal year. Because you can have a certain parameter to compare the offering. So last question for today. Question 50. The function and responsibilities of the sponsor, AMC, trustees and custodian of a mutual fund are listed in A. Offer document only, B. Key information memorandum, C. Both offer document and key information memorandum, and D. None of the above. Answer is offer document only. So we have completed question number 1 to 50 today. If you have any question, any doubt or any feedback, please comment us. Any of the questions that discussed here required further explanation or solutions, then please write in comment. We will provide that separately. Thank you for watching. We will meet very soon with next set of questions. Till then, take care. Bye-bye.
Please subscribe and press the bell icon to never miss another update. Please like, share and comment.